Welcome. As we all know, as an Australian expat living in the US, filing your property tax returns or even applying for a home loan in Australia can be a daunting process. Having a reliable expert on hand can make all the difference. This is why I'm excited to introduce our guest today from Odin Mortgage and Tax. Ben Wong is a mortgage broker and co-founder, and Pao Lam is the Expat Tax Director. So Ben and Pao, welcome. Ben, let me first ask you to introduce yourself and Odin Mortgage and Tax.
Thank you, James. It's great to be here. And sure, I'll do a quick introduction. My name is Ben Wong. I'm the head mortgage broker of Odin Mortgage. We're a licensed mortgage brokerage and tax agent for Australian expats and foreign nationals living anywhere outside of Australia who are looking to purchase property in Australia and lodge their tax returns. We've assisted over 5,000 Australian expats and foreign nationals over the years, and this is our bread and butter. It's what we do day in, day out, and we'll be able to advise you exactly what you can and can't do from a mortgage finance and taxation perspective.
Ben, let me first ask you, how do I obtain financing as an expatriate?
This is essentially what our whole business is about, assisting people obtain finance while they're overseas. And it's a lot different than when you are living in Australia. Actually, one of the biggest things when you start out is really understanding your eligibility. I would say that's the biggest thing. And I would like to start off, I think the biggest one to address is the nationality. What is your nationality? If you're an Australian citizen, you're going to have the easiest time, followed by if you have a permanent resident visa in Australia. Then if you don't have a citizenship, like let's say you're a Hong Kong citizen or a US citizen looking to obtain finance, that would be the hardest. So I bring this up because a lot of Aussies, are married with a US citizen, for example, and then therefore there's now a foreign national involved. And so that does get harder. And I kind of like to use an analogy of a funnel. You start off at the top here because in Australia, there's over 40, 50 different banks and lenders. So there's a lot of lenders. And if you're living and working in Australia, you have all of these options available to you. But as soon as you're living overseas, earning foreign income, that goes down to probably around 10 different lenders that you're looking at. And I would say it depends on your nationality at that point. If you're an Aussie, then you have available to all these 10 different lenders. And the second main criteria would be to do with your income. The banks right now, they love employees, pay-as-you-go employees. And if you're an employee, then you still have these 10 options available. But as soon as you're self-employed, so let's say you're a contractor or you're self-employed individual, then that actually reduces the banks down to around two or three different banks or non-bank lenders. So that would be the second main thing that you would look at after nationality, which is your income type, employee or self-employed. Currency is one that they look at as well. They do like what they call gold currency. US dollar is obviously the reserve currency of the world. And so if you're earning USD, that's acceptable by all the banks. Other things would be such as, what type of property that you're buying. But I would say that one applies to everyone, not just the people living overseas. So understanding your eligibility would be your first point in trying to find out what sort of lending that you're able to get. The banks are really looking at two main factors once when they think about lending you money. The first one is your income, and then the second one is your deposit. So I'll briefly touch on these two. The deposit one is quite straightforward. The banks are lending between 60 to 80% of the purchase price. So if you're borrowing 80%, that means you need to come up with the other 20% yourself as deposit. So they just want to see that you have savings in your bank account or other liquid assets, such as shares that that would all form part of your deposit. The income part is the more challenging one, whereby we see a lot of our clients struggle with a little bit more. So the banks want to understand your income to see if you can borrow through the stress test. They'll take your income minus your expenses and whatever disposable income you have left, they'll calculate how much you can borrow based off on that. So the biggest thing that most expats don't realize is how strict the banks are on their US dollar income. Because virtually all lenders will discount US dollar income by 20 to 40% straight off the bat. And they discount by 20-40% for the currency fluctuation risk between the USD and Australian dollar pair. Because I think post GFC, you can see, at one point the Australian dollar was worth more than the US dollar. During the resource boom, the mining boom, where China was buying up all the iron ore and resources, huge demand for the Australian dollar currency. It was worth more than the US dollar at that point. But now I think we're trading at around 66 cents per dollar. So that was a huge difference there in foreign currency fluctuations. So that's why they have that clip, which is fair enough. But yeah, 20% is the standard. And after that, they will apply the US income tax rate or the Australian income tax rate, whichever one is higher. So at the end of the day, we're probably only looking at 30 to 40% of your net income. After you take off the tax, if you're a high income earner, the tax can be, close to 50% of your gross income plus the 20% off. So yeah, like 40% around there. And that's what the banks will look at to see how much you can borrow. So someone earning, over $1 million a year can be surprised how little they can borrow once you factor in all of these haircuts. And in terms of your expenses, they apply a lot of buffer margins as well. You're thinking you're borrowing a loan for 5%, 6% interest rate, but the banks will add on an extra 3% on top to account for future rate increases. So obviously the last 11, 12 months, we saw rate increases month on month, not just in Australia, obviously globally and especially so in the US. So yeah, they add on a further 3% on top. And you're going to have to service your loan based on those inflated repayments. And that's where we come in to help you understand what are your lending options. You think you have 40, 50 different lenders, banks, and options, but really, probably by the end of the day, once we've spoken to you and understand your personal and financial situation, off the top of my head, probably you're only looking at 3 banks already at that point, based on credit policies. And I'll be able to advise you exactly how much you can borrow and at what loan to value ratio, because the banks are lending, not all banks are lending up to 80%, some only 60%, some only 70% if you're living and working in the US.
So Ben, what is the process for purchasing property in Australia as an expat?
The first step really should be getting your finance pre-approval. But I'll juxtapose this with what it would be like if you're living in Australia. Because before I was mentioning how in Australia there's over 40, 50 different banks and lenders. If you're living and working in Australia, you earn Australian dollar income, and every bank treats you the same. So there's there could be common knowledge like whereby it's easy to get finance in a way, because every bank is going to accept you, every bank's going to treat you the same. But it's not the case when you're living overseas, for some of the points that I've already touched on. So really, truly understanding exactly how much you can borrow before you put down offers on a property and buy property in Australia would really be the first step. Because you're going to be very surprised how little or that you can borrow when you're in America, with all the income tax and the shading. So that'll be the first step. Okay, so once you do have your pre-approval, and I'll give a quick timeline on that. So once we have the discussion and you understand what your lender options are, we send you a link to upload your documents to prepare your application for submission. At the moment, it's taking around 3 weeks to get the loan pre-approved. In Australia, for example, it will only take around 4 to 5 working days to get your loan pre-approved. So you got to factor that in. It'll take around 3 times longer. Once you do have your pre-approval, though, it will last for up to 3 to 6 months. So that's plenty of time to go find a property. And once you have found a property, you provide us with the contract of sale. And then we can get the bank to order a valuation on that and get your loan formally approved. That's with the loan contracts for you to then sign. There's some more legal requirements in terms of who can sign your documents, but we'll provide you instructions at that point in time. But taking a couple steps back, once you do have your pre-approval, you can find your property. And what we saw with our clients is, if you have friends and family, some people would use that. Or some of our clients will actually fly down back to Australia to then start their property hunt because, they want to be involved physically with that process. But I would say a third of our clients would actually use buyer's agents. So whereas say in Australia, maybe only 5% of people use buyer's agents to source a property, I'll say around a third of our clients utilize the service. Because as you can imagine, it's quite hard to find the right property when you're overseas and you're not physically inspecting the property and you're maybe out of touch with the Australian property market. So these guys, buyer's agents, they'll work on your behalf. they're not paid a commission on the sale of the property. So you pay them a fee. So they're working on your best interest. That's generally how it works. We do work with 3 pretty top tier buyers agents. So if you need referral, we can obviously introduce you, where they have a strong analytical team, like data analytics team as well. So they do it purely based off on figures and numbers. It's more from an investment perspective, but also if you're buying your own home, I know there's an emotional aspect to that as well. But I guess it's nice to also know that your property will be appreciating in capital, even though it's not primarily an investment. So going back to where I was before, once you do have your loan formally approved and your contract signed and sent back, that's when you'll be proceeding to settlement. But at that point in time, you would want your own solicitor or conveyancer to represent you at settlement. And for this one, it's not so much required to have an expert that deals with people living overseas. I think anybody in Australia who's familiar with property law will be able to handle your conveyancing needs quite adequately. But they'll represent you and they'll do all the paperwork and things like that. I haven't seen any one of our clients ever try to do this themselves. It's not worth their time. Even lawyers, we have a lot of our clients who are partners at law firms and so forth. They would not do this themselves too. It's just not worth the time. So you would engage a lawyer, probably like $1,000, $2,000 in fees, and they'll represent you and ensure your settlement goes through on the day of settlement.
Pal, thank you for joining us. What are the tax implications for expats buying property in Australia?
Thanks, James. So for Australian expats trying to buy back in Australia, I would say first we need to identify what are the tax residencies for Australian expats. In general, for expats living in the state, you are being classified as a tax non-resident of Australia, which means you are only subject to report whatever income that you receive inside Australia. None of your US income will need to be included in these assessments. So for income, for that Australian income that we're talking about would include rental income. Obviously, if you're getting an investment property and rent it out, you would receive the rental income. There could be interest income from the bank or dividends income if you do have shares. But let's just focus on properties and rental income. So as long as you do have received rental income in Australia on these properties, you would need to report this income in Australia on a yearly tax return basis. However, the government do allow you to have negative gearing on these properties. And that means if your expenses are greater than the rental income, that you do not need to pay any tax. And they do allow you to capture all these loss and you can carry forward to use in the future. And for another instance, which is the capital gains tax, which when you sell the property in the future on these rental properties, there will be a calculation to calculate how much capital gains you have made and what sort of tax that you need to pay. We simply look into the sales price on these properties when you sell in the future, compared to the cost of buying and selling the properties, including stamp duty, legal fees, commissions when you use an agent to help you assist you with the purchase and sales. All these will be taken into account. For now, the interest rate are fairly high for Australian tax non-residents. We do not get any tax-free threshold compared to the local citizen, local residents in Australia. From $1, we will need to pay at 32.5%. And the rate could go up to 45% if your income is at a level of more than $180,000 for the year. That will only happen when you sell the property, most likely, which you see a huge capital gains and you may be taxed at the highest level at 45%, which is very similar to the US rate, I believe.
Pal, are there any restrictions on foreign ownership of property in Australia?
There's no restriction for Australian expats buying back in Australia for properties. You can buy existing, you can buy brand new, you can buy off the plan properties, and it can be residential properties or commercial properties. It will be easier to get a mortgage on a residential property compared to a commercial, but it's never a no to the bank. At the end is we look into applications and see what we can assist. There's no FIRB fee, which is the Foreign Investment Review Board fee. This fee will only apply to foreign national, which means you are not an Australian citizen or not an Australian PR. So for Australian citizens living overseas, there's no extra cost for them to look and buy in Australia. But there's one instance where it's a bit of unique scenarios. Is if you are an Australian PR living overseas, and you're looking to buy back in New South Wales, then you will be treated as a foreign buyer because they are, I'll say, a bit greedy in the sense that they treat Australian PRs living overseas like a foreign buyers. If you're not living and working in Australia for last more than 200 days in last financial year, they will then see you as a foreign buyer, which means you need to pay the stamp duty surcharge, which right now is at 8%.
Ben, you mentioned before about exchange rates. How can fluctuations in currency affect your property purchase?
Yeah, good question. So with the Australian, like technically you're buying an Australian property, and the value of that property is denominated in Australian dollars, right? So usually the safest thing to do is to also borrow in Australian dollars as well. So you minimize the currency risk. But things are not that straightforward for expats, because the income that you're earning, the bulk of your income that you're earning is not Australian dollars, is US dollars, I would say, for 95% of you. And so potentially you may feel that borrowing in US dollars is actually safer for you. And we had banks in the past that offered dual currency lending. So you can buy an Australian property, use that as security, and you have the option to borrow in US dollars or Australian dollars. But in the last several years, that has ceased. Like the Australian banks no longer offer dual currency lending. I think mainly for the reason that most applicants do not understand the currency risk, because you can get margin called on the loan. Margin call is pretty much like, let's say you borrowed in US dollars and the US dollar started depreciating heavily against the Australian dollars. And at the end, before I was saying, like, the banks will only lend you up to 80%. So let's say you borrow 80% on your property at the start, but you borrowed in US dollars, but then now your US dollars is worth half of what the Australian dollar was. So technically you're no longer at 80% loan to value ratio. It has exceeded that now. The loan to value ratio, when converted back to Australian dollars, is now over 100% even. That's an extreme case. It doesn't go from 50% of Australian dollars value like that from a USD perspective, but I just wanted to paint a picture there. So when you're over 80%, the banks are going to force you to bring it back down to 80%. So they're going to say, hey, James, you need to top up your loan. You need to pay down your loan by $20, $30, $40, $50,000 to bring it back down to 80%. And if you can't do that, then they foreclose on your property. And there was a period in time over the last several years whereby there was crazy foreign currency fluctuation, not specifically the US dollar, because they were offering this to, Hong Kong dollar, Singapore dollar, like all sorts of currencies you can do dual currency against. And when you're living overseas, for people, it was very hard to get people to pay down their loan. They're not able to enforce it. I'm talking about the lenders here. They weren't able to enforce it, and it was very hard to get people. You may not even come back to the country. So all of this risk added up. It was no longer worth the lenders offering this type of product. So now they really only let you borrow Australian dollar for your loan. So that's about dual currency lending. But in terms of the risk as well, how would you mitigate the risk? I'll say, even though you're borrowing Australian dollars as a US living and working in the US, it's still okay, because you're renting out the property, most of you are, and you're earning Australian dollar income on that rent. So it is offsetting a lot of that, that mortgage repayment. So it's not too bad from that perspective. Whenever you think the rate is good, between the AUD and USD, you just buy a bit of Australian dollars. Yeah, whenever you think it's good, you just buy a bit of it and then put it down into your offset account. If you already have a home loan, just put it down there, and you can just keep transferring it. There are a few ways that you can buy the Australian dollar currency. Most people do it the easy way, which is just through their bank, but that's probably the most expensive way.
That's a good point, Ben. We actually have a relationship. We get a preferred rate for our members through OFX.
Yeah,
And, if you're transferring more than $1 million, the rate gets even better. So,
no,
we've had members literally save tens of thousands of dollars over a bank by using that preferred rate that we negotiate. We negotiated that, I think, over a decade ago with OFX.
yeah,
Actually, an interesting point you talked about with margin calls. Right now, of course, we're at, as you said, about 66 cents. So I actually transferred some money. I got 1.5 and change. So, $100 became $150, so to speak. So
mm,
you might think that's a great opportunity to buy property in Australia, but if the currency moves back the other way, and you've as you've said, you've kind of locked in you think, oh, I can afford this because of the exchange rate. But if that exchange rate, say, goes back to 75 or 80, as it may do in the next 5 years, say, then you're going to be looking at your US dollars are buying fewer Australian dollars. But I think it would be very foolish right now to think, great, the fantastic rate between Australia and the US. Let's get a 5 handle on $1 million property in Australia, and then realize in a year or two time that the mortgage is a lot more than it was before because the Australian dollar is stronger.
yeah, yeah. Absolutely, I agree with that. So I think at the moment the US is just strong, right, against the AUD, and it does help all of the expats there, because not only is your deposit worth more, because I'm assuming your savings in US dollars, and you can buy a more expensive property, but also from your income as well. Because when we're doing the borrowing capacity, the stress test, you're earning US dollars. So now it does appear that you are earning more, like more relative to
Yeah.
Australia. So you can actually borrow more Australian dollars as well. But yeah, the reverse is true. So when it starts flipping the other way, you can quickly start being, you won't be able to borrow as much, your deposit's worth less, that kind of thing. So if you want to mitigate, yeah, you do like that dollar cost averaging, I guess what they call it from an investment perspective.
Yeah. What are some of the ongoing costs associated with owning property in Australia?
In general, you will need to pay the council rates and water rates where your property is located. This is more the council expenses, and depends on what sort of property that you're buying. If you're buying apartments or townhouses, there might be strata fees which you need to pay to maintain and manage the properties of the one you're buying. But if you're looking at houses, then there might be land tax, and land tax is somehow a hidden fee to expats because they don't really being talked to too much. Land tax is calculated in the sense that it depends on the state as well where you're buying, and this is a state fee where the state government charge you. Depends on what sort of property that you own and what is the land value of total aggregated amount that you have in that state. There's a threshold being offered by the state government, and the threshold values varies between different states. For example, in New South Wales, they give you threshold close to $1 million, which means as long as your land value in that state in New South Wales is no more than $1 million, you do not need to pay any land tax. And just bear in mind, land tax is an annual fee, and it could go up to, we're talking about 20, 30,000. As soon as your land value is much over the threshold, you will need to start paying the land tax. This is somehow why I said this is a hidden fee, because a lot of the buyers expect they are not aware of the land tax, and they go into property market and just buy a house with a huge land value attached to it. And they just realize after a year, when they receive the notice bill from the state revenue office, realize they need to pay 10,000, 20,000 land tax. And it comes to a regret that it is not included in their budget, and they might need to sell the property just to get rid of the land tax. And it somehow would cause them extra costs in buying and selling. So something to watch out is the land tax, but there are other fees you generally to watch out as well, which is if you are using an agent, there might be the agent's management fees, or even if you're getting a mortgage, the bank will require you to have insurance on the property. So the insurance policies will be another cost. And all those maintenance or repairs of the properties will also be the ongoing cost you need to take into account as well. And of course, the mortgage. And if you're going with a variable rate, it goes up and down with the interest rate fluctuations.
And what are some of the considerations for renting out your property living abroad?
In general, most expats would use a property agent to help them manage a property because it's so hard to manage yourself while you're living overseas with that distance and the time difference as well, time zone difference. So agents would help in the sense that they would help looking after, help you get a tenant, help you manage to receive the rental income, and help you pay all the expenses, including those I mentioned, the council rates, water rates, repairs, and maintenance. They would help you in the sense you don't really need to take much of care on the property. They would receive the rent, pay the rent, and pay you whatever the net rent is to your bank account. Of course, you can use your own people, or you do have families on the ground. They can assist you on this. But generally, I would say 90% of the expats would use an agent just to take out all the hustles, let the agents to take care of all these. And just at the end of the day, you still need to report this rental income in the tax return, as I mentioned before. Depends on whether you are in a positive position or negative positions, and to figure out whether you need to pay tax or not. And again, all these will be a yearly process. You need to report and lodge a return every year, so that somehow we can assist you with the tax preparation as well.
So Ben, what mortgage options and loan features are available to expats, and how do they differ from those offered to Australian residents?
Yep. So I don't know if this is surprising or not, but the loan products will be exactly the same as you're living in Australia. So you don't get penalized in any way for residing overseas. The only way you get penalized is just your lack of options. That's all. So instead of 40, 50 banks, you just have, like, let's say the 5, 10 banks. That's all. But in terms of the features, it's all exactly the same. So I'll quickly run through the features here. So in terms of the interest rates itself, you can do variable or fixed. So variable is just a floating rate. It goes up and down depending on the Central Bank of Australia, the RBA. And when the RBA goes up in the rates, you can expect that the variable rates will go up like for like. Or you can choose to fix your interest rates for 1, 2, 3, 4, 5 years. And fixing interest rates was great back in 2021. I think the vast majority of our clients did fix. But now fixed rates are actually higher than variable rates. Well, historically, fixed rates were always meant to be higher than variable rates. But in 2021, it was kind of reversed there. You could fix your interest rates for 2%, even lower. And some people did do that for up to 5 years. So you won big there. But historically, people who fix the interest rates don't come out ahead financially, because the banks already have like their hundreds of analysts who have already kind of calculated the cost benefit, for fixing. So people would still fix if it's, for a budgeting purpose, I would say, rather than trying to come out ahead financially there. So you can do fixed or variable. And then in terms of your repayment structure, you can have principal and interest repayments or interest only repayments. So obviously principal and interest repayments, you're paying down your loan, right? The capital down, the principal down, over a 30-year loan term. Whereas interest only, you're just paying the interest. So your balance will always stay the same. And why someone would do that is mainly from a cash flow perspective. If you're paying the interest only, you're not paying the principal. So your monthly repayments is a lot lower. And for maybe savvy investors or people who are very confident with their money, then you may just do interest only. And then you have more cash flow for other future investment purposes, or maybe things are a bit tight personally at the moment, so you just want to do interest only. So you can choose between those two repayment types, okay? And then in terms of loan to value ratio, this one is I would say this one is actually different for expats. So when you're living in Australia, you can actually borrow up to 95% of the loan, of the purchase price. So that's where probably is the biggest differentiator there. So the LVR, repayment, and those are the 3 main ones. I want to see if I missed anything else there. Yes, redraw and offset accounts. That's probably the most requested feature for most people looking to buy a property, get a mortgage. So I don't know if you're familiar with what an offset account is, and whether it's common in the US or UK, but it's pretty much a separate account. You have your mortgage account, the loan account, and then you also have a second account, which is your transaction account, because you're going to pay the mortgage every month from that transaction account, and your rental income would go into that transaction account. But this transaction account has an offset feature. What that means is however much money you have sitting in that transaction account, it will directly, passively, or actively offset the mortgage interest on that. So I'll give you an example here. If you have a $1 million mortgage loan account, and then you decide to put in $300,000 into your transaction account, you only pay interest on the difference, which is $700,000. You only pay interest on that. And if I go extreme here, if you put in $1 million into your transaction account, which has an offset feature, you pay $0 interest every month. So instead of paying off your loan directly, most of our clients choose to use an offset account and put their money in there instead of paying off their loan. And that's just for cash flow, again, flexibility. Because if you paid off your loan and then you needed that money again, it's going to be very hard for you to get the money out because you just paid it off already. You closed off your loan account. You can't get that money out again. You would have to do an application to get your money out, and the banks may say no because you need to verify why do you need that money out again. And the banks have a very strict requirement now to give you money out. It has to be for a very responsible or investment purpose. But if you're like, hey, I just paid it out, ahead of time, I actually kind of wanted that for personal reasons, they won't give you that money out again. So rather than that, just utilize your offset account and you can take money in and out whenever you like. It's just a normal transaction account.
Ben, you mentioned interest-only loans. I have known a few folks who have done interest-only loans because their view is that I'm not going to live in that house for more than 10 years. So why would I, go to the extra expense of paying down when I know I'm going to sell it and have a capital appreciation? So what they might look at is that they'll take an interest-only loan. In 5 or 6 years' time, they could sell the property, pay back the full value of the loan, take the capital appreciation, and they've been able to service a much larger amount of money. I mean, let's face it, how many people live in a house for more than 10 years?
Yeah, and that strategy that you just mentioned was very popular because it was popular because for the reasons that you mentioned and because the interest rates were exactly the same. But something changed 6 years ago, which was Australia. They moved to a 2-tier pricing structure, like in the UK. So if you're borrowing interest only now, there's a premium on that of around 0.3%, 0.2 to 0.3% dearer. So it's going to cost you now to borrow interest. But back then it was exactly the same. If you did principal and interest or you did interest only, it was the same interest rate. So a lot of people just be like, well, I only can see upside with borrowing interest only. So I'm just going to do that. It gives me more flexibility. I'm diligent with my money. So I'm just going to borrow interest only. My loan balance stays high. I can claim more interest deductions, so for negative gearing. So there's a lot of pros, if you're diligent with your money, then it made a lot of sense. But now if I put in that factor in, I was like, hey, if you want to do this, it's going to cost you an extra 0.3% in your interest rate. It has made a lot of people rethink, investors included in that. So the vast majority of investors now are actually doing principal and interest to reduce that interest rate. And if they needed money again to bring that loan back up, they would just do a cash out loan. We can top your loan back up with so long as it's an investment purpose. So if they're trying to buy that second property, investment property, and if you paid it down to 60, 70% loan to value ratio, we can go back up to 80% and use that for that next investment.
Pal, are there any government incentives or grants available to expats purchasing property in Australia?
Yes, there are some general, like for example, first home buyer grants or stamp duty concessions or exemptions, which is available to first home buyer in Australia. However, this might be a bit tough to be applied to Australian expats because of a couple of reasons. First of all, this would unlikely to be their first home. And even if this is their first purchase in Australia, it is hard to determine or prove that this will be their main residence that they will be living in. So from that instance, from that aspect, the government would not approve and give all these grants or stamp duty concessions, exemptions to buyers who is living overseas, as it is hard to prove that you will be living and moving into these properties. There are only few cases we have done before, which the client is actually intending to relocate back to Australia. And then in that instance, we can apply and get these grants. But I would say for most 90 to 95% of our clients would not get any of these grants, given that it's so hard to get approved. But I would say from another angle, these grants are not a huge amount because usually what we're talking about is somewhere between 100,000 Australian dollars in terms of the grant. So it doesn't really change or affect too much in terms of the cost of buying in Australia.
How does negative gearing work, and can expats take advantage of it when investing in Australian property?
So negative gearing works in the way that if your expenses on the property is greater than the rental income, and as such, you do not need to pay any tax on this rental income because you're in a loss position. And these loss positions, this loss, what we call income tax loss, can be accumulated and carried forward indefinitely, to the point that when you start to get positive rental income, or you do have other income that you can utilize these losses. For instance, like if you do sell the property and you do see a huge capital gains, you can offset from these losses that you have accumulated over the years before calculating what is the net income that you need to pay tax on. It is encouraged for expats to try to get and do negative gearing, because imagine if you only need to put down 20 to 30% of the property costs and you can earn a property, the rest can be coming up from the bank, who can lend you between 60 to 80%. Then literally, and as long as the property itself, the rental can be cover some or most of the expenses on the property, it doesn't really cost you too much. What you are literally paying back is just the principal of the mortgage. And this is how our clients, for expat clients, start to build up a portfolio. When you imagine you only need 20, 30%, and you can diverge your own funds into a couple of these, and you can start setting up a portfolio between 3 to 5. And as long as the rent is enough to cover all the expenses, literally you don't really need to take too much of care on these properties. It should be able to self-manage itself just from the rent itself.
Ben, I want to thank you and Pal for your time today. This has been very informative. This is a very complex matter. And as you said, having someone that can guide you through the process, not only from the mortgage side, but also supporting with the tax side, I think is very important. For anyone who would like to reach out to Odin Mortgage and Tax, we have a webpage, aucommunity.org/Odin, that's ODIN. And there, folks will be able to see a link where they can click on to contact and reach out to Ben or Pal or any of the team there at Odin. So again, Ben, thank you for your time today. This has been very helpful. Thank you.
I'd like to take a moment to sincerely thank you, James, for this opportunity. It was a pleasure to delve into these important topics around Australian tax and mortgage finance. I appreciate your insightful questions, and I hope the conversation was beneficial to your viewers. To your audience, I wish to express my gratitude for your time and interest. If any of you have any more questions or need further clarification on anything we discussed today, I encourage you to reach out. We're always here to provide guidance and support as you navigate your financial journey. In conclusion, understanding the nuances of the Australian tax system and the intricacies of the mortgage finance can be complex, but with the right advice and guidance, anyone can successfully navigate these waters. It's all about finding the right fit for your individual circumstances. So once again, thanks, James, and everyone who tuned into the interview. Stay informed, make wise decisions, and here's to your financial success. Goodbye, and take care.
Thanks, Ben. Appreciate it.